What's up, YouTube? It's Joe Catchpolia sitting on the couch making some money investing in fractional real estate online as usual. I know what some of you were thinking. How are you putting out a video on Christmas? Are you a workaholic? Don't worry. It's after midnight, so it's not Christmas anymore. So back to a normal workday, December 26th. Okay, so what I want to talk about today, I've been talking quite a bit about what I've been calling the discounted token strategy on Lofty. Um, it's when I'm buying tokens on properties. These are three examples here where I properties are not yielding any cash flow, and I think there's a number of different reasons, but the biggest one being that they have a hard time overcoming expenses and capex, but the tokens are being sold at a price where it's a significant discount to the real world value of the asset. And so this happens because there's plenty of properties out there that you might, when you purchase it at full price, or no matter what price you purchase it at, it doesn't make sense to use as an investment property because the rents that you can get in the market and the turnover and the cost associated with renting it just doesn't make any sense from a rent to price ratio. But even sometimes, regardless of the price, um, it's just too hard to overcome the operating costs to create any sort of actual profitable situation. This, I think, comes as a surprise to some newer investors. Is they think, oh, if we buy that property at the right price and you rent it, it should be perfectly fine. But sometimes, when your taxes and insurance, prolonged vacancies, and the cost of turnover, repainting units, sometimes all that stuff added up, your rents just aren't high enough to make it work. And I think that's the case in some of the Chicago properties. I did a video yesterday about Odom and really showed that like it's not that it can't be run profitably, it's just that it's a very, very low profit relative to the real world price of it. But in any case, I so these they end up having no yield on the platform because they might have some cash flow to the property, but it's often going into the operating reserve to replenish it because it was used for a turnover or it was used for taxes or something like that. Um, but I've been buying a lot of these because I think there's an opportunity to purchase the tokens and then eventually push to sell the property in the real world. Keeler is currently under a contract, and this is one that I think is going to work out really well. You can see my average cost basis. Remember, Lofty doesn't show your fees in this number, so I'm probably, I don't know, closer to 26 or 27 bucks per token on this, but we're currently under contract to sell it, and I'm going to net somewhere around $38, I think. 37, 38. So per token. And so, 56 tokens. It's a nice little spread. This will be bigger than the first one I've done, and each one that I'm working on, I think will be a little bit bigger than the last when it gets to the point where it sells. I was talking about Odom yesterday. I think this one I think the most rational thing to do with this property is to sell it because holding it, we just get such a low yield. And I know there are some people that, if they sold it, would lose money. But I think that reinvesting that equity into a higher yielding property would actually, um, almost any way you look at it, be better off than holding it for some long term period of time, um, and then selling it and maybe breaking even because of appreciation. But so I wanted to do some math on this because I think the time value of money is really lost on a lot of people. And a lot of people reached out to me after I did that, and they made comments like, "Oh, I like to hold the property for 5 years, or I like to hold for a certain holding period." Some people said 3 years. Some people said longer. Oh, I think we should hold it forever. And um, I understand the concept of real estate as a long-term hold, and that's what I've often bought at. I just don't think that. Um, a lot of the properties that are on Lofty's platform are well suited for it. And it's because there's just a whole bunch of them that they're just not, they're either in poor, not the right market, they're in really tough markets to operate, or the property itself. because so like I think Odom is actually too nice of an area to have a very successful midterm rental anyway. I think that the property itself, while owner occupants just going to spend, they're just going to be willing to pay too much money relative to what somebody's going to rent it for. And so it's just, from that regard, looking at the revenue to the price, it's not a great long-term hold. But so wanted to just kind of show, when you, especially when you're able to get this sort of discount, well, there's a couple of things. I want to show the math on, why I want to try to push for sales early. But then on top of that, one of the things that I hadn't really thought about is the fact that when you're buying these discounted tokens, if you're in markets where there's appreciation, which is not the case, I don't really expect a lot of appreciation in Chicago, but I think the Fort Worth one, there's some real potential, if I did get stuck holding it long term. And one of the things that I hadn't really thought about is that the appreciation is levered relative to my discount on the tokens, even though there's no actual leverage on the property. So I thought that was kind of neat to look at when I was messing with my numbers. And so I did a little spreadsheet where I'm actually pulling that out of the numbers. But first, so take a look. I think I'm just going to do some generic math here. If I've got, I'm just going to do $50 tokens. I've got $50 tokens that my average purchase price has been $50 or $30. Um, just doing some math on if I sell it, and you'll see that this profit number doesn't add up right, and it's because I'm assuming about 9% closing costs on sale. Sometimes, I've talked about this quite a bit. I use it to be conservative. Sometimes you have quite a bit more. Sometimes you have, no, rarely will you have quite a bit more. Sometimes you have significantly less. It depends on how much you're paying the realtor. If we have used realtor, which we seem to always use on Lofty when we're selling, and if there's depending on what state you're in, the way property taxes are prorated can vary quite a bit. And so I always like to use 9%. I think that it's very rare that you end up exceeding that. Anyway, that's where this math comes from, right? So bought it for 30, it's worth 50, sells in real life. After closing costs, you made $15 on that purchase. Now, if in a scenario where you do that and it takes exactly 1 year, and you make a 50% return, right? And I'm just calculating the IRR. If you're not familiar with that term, that's just the internal rate of return. I'm using a formula below where you just enter cash flows. In the beginning of the cash flow, you just put equals IRR, and it gives you this. I think there's a more precise calculation you can do with X IRR, but for what I'm trying to just show you here, this works perfectly fine. So you can see, in this scenario with no appreciation and no cash flow, if I sell it within the first year, I'll make a 50% return. But the next year drops down to 22, next year it drops down to 14. It really just drops off a cliff, right? Like you're losing quite a bit of money. This bottom line that I did is okay, let's say we're getting a little bit of cash flow. Because, for example, on Odom, I think on average, I think we'll fill up the reserve and then we'll get a little bit of cash. But I think, it'll be very small. And so I use a 3% cash flow relative to the initial value. And, you can see, well, that actually helps our IRR quite a bit. One of the things that's interesting is using it. You end up it ends up helping your IRR more than you would think sometimes. And like why is adding 3% cash flow? Oh, did I screw that up? Let's go down and look for a little source stuff here. Uh, no, okay, just making sure. Um, but anyway, adding the cash flow, it helps you a little bit, but it doesn't take very long still to drop down to, if on a 5-year hold, 12% IRR, it's not terrible, but it's not 54%, right? So it drops off really fast. One of the things, and I haven't really been thinking about this much at all because most of the markets where I found these discounts, I'm not assuming there's going to be any appreciation long term. I've mentioned it a few times. Fort Worth is a market I really like. I think in the long run it is an appreciating market, but if you look over the last couple of years, it's been really flat. Um, let's see, that is not, is this the right zip code? Let's go back to uh, 76114. Yeah, that's the one, right? So this is the zip code that that Odom's actually in. It's been super flat. Um, Zillow thinks, the 1 year forecast is 0.8%. So, that's not going to really have, so yeah, zero point 0.8. Oh, oh, no, 0.008. There we go. It's not going to have much of an impact at all. But one of the things that I think is really interesting is, 0.8% ends up being 40 cents. Appreciation the first year, it's even, it's so small it doesn't add up. So I'm going to stick a number in here, um, where you can actually see the change each year. So one of the things that's happening, okay, so it's actually worth $50, right? If I'm getting a 3% appreciation annually, okay, the first year that's $1.50. Well, $1.50 compared to my actual purchase price is a 5% appreciation relative to what I bought it for, right? And so that's one of the things when I'm saying like my appreciation is levered. um, you're actually getting more benefit from that appreciation than relative to your purchase price. And so when I start to mess around with that a little bit with my IRR, um, you can hold it. It still drops off precipitously, right? Like you're still going. Um, your first year is 54, 26, 17. But the more, if we were in a market that had, some relatively strong appreciation, 4 or 5%, you can get out into 3 or 4 year holds where you're still getting, pretty solid returns. And again, I mean, these are returns, or, even better if you are getting a little bit of cash flow. And so this is one of the things that, one, I think this initial like drop off is lost on a lot of people, right? I think that, and anybody who just wants to kind of wait and see what happens with these properties, oh, let's give it another 6 months. Let's give it a shot at doing this other strategy. Let's, you know, you're for anybody who's bought it at a discount early, or recently, or anybody who's bought it at a discount at all, you're really just crushing your returns by taking an extra year to do it, right? And so you might think, well, I'm making the same amount of money, but you're not really, because if you realize that return earlier, right, I make that money next month instead of next year, well, then I can reinvest it into the next one of these. And there's no shortage of these properties on Lofty, right? Like, I mean, there's a ton of these discounted tokens, and it's not just ones. um, at first I thought, oh, we're going to run out of these because, we have, because they've really figured out the problem, right? And I think that they have to a certain extent. I think that there are less of the properties that just are going to fall off a cliff, and get cut in half, but you still have some. I'm going to see if I can find you ones that I, uh, am aware of. Yeah, so you've got some that are already starting to fall. Like this is a co-ownership property, right? Sorry about that. Looks like I froze for a second. But yeah, this is one where I own. I think I bought this one, at higher than this price where it's currently at. But there are quite a few of these. A lot of them are short-term rentals, but there are others, that just for whatever reason, they have a co-owner, but they're still not doing well. And so even though the co-ownership model is maybe helpful in keeping, I don't think that there are any that have these huge discounts right now, although there are some that did for short periods of time. I think there was a time when you could have bought this one at $36, if I remember correctly. Let's see if we can see that in this. Um, 62. Let's go further back here. Oh, maybe I'm thinking of the wrong one. 50. Oh, I must be thinking of the wrong one. Um, oh, I know which one I'm thinking of. It's Olive, so let's find that one. Okay, here we go. Um, this is one 47. Let's go back 9 days. Yeah, this was all the way down to $36 at one point. It's a co-ownership property. And it's back to 50, right? So I mean, this would have been one which would have been amazing if I had bought it at 36, just turned around, sold it when it got to 50. It took less than 90 days. You can get a great return there, but even if not, I mean, it's this is. I think there's just always going to be this potential. There'll be little hiccups with the properties, and you'll start to get some of these discounts. And so that was my only point. I think um, one of the things I think of a lot is this just a short-lived, having a hard time here. Let me get back to this. Is this just a short-lived opportunity? Am I spending a lot of time messing around with this, trying to figure this out, and then all these deals are going to be gone? But I don't think that's going to be the case. And I think, if we sold Odom, got that, what I think we're probably going to net is like $40 a token on that. Um, and there's plenty of others to dump it into and then to do it again, right? And so, like, if you're able to do that to two in a short period of time, oops, escape out of that. If you're able to do that, within a year of when you've bought your tokens versus within 2 years or 3 years, I mean, it just turns into just a much different deal. And so that's really all I wanted to talk about as far. So let me make sure just wrap that up in a way that I think, in case the second point wasn't really clear, right? So one, by making it happen really quick, we're just juicing our returns a huge amount. Although, one of the good things that, as I've done more math on this, I'm actually really happy with these. Um, I mean, the downside on some of these for, uh, with no appreciation, and I get stuck with it for 5 years, and I'm still making an 8% return. I mean, I'm really not happy with it at that point. But it is, it's that's a pretty nice downside to look at. Now, obviously, things could go worse. Um, we could lose money along the way. We could have to do capital calls. It might never actually sell for the price that people think it's going to sell for today. All those sorts of things. So you do want to do all your own due diligence for each one of these properties. But so that's the first point, right? Like it's the time just makes a huge difference. But then the second point is really just this, is in that um, we are, because of the difference between the token price and the real world asset price. By buying at that discount, it's sort of giving us leverage because, for example, here, 5% of appreciation on the actual property level appreciation gives us an 8.33% appreciation on our tokens. And do I think we're going to get 5% appreciation? Not on many of these. Could we get to two or three? I think that that's really reasonable. And if it's three, that's at least in the early years. It's three goes to five, right? I mean, that's a big jump, and it makes a big difference in our returns. One of the things that's kind of interesting to see is that over time that effect is muted, right? It starts to go down, even though um, I'm holding this 3% appreciation constant across this top line, and it's the rate of what we're experiencing it is going down, and over time it will get very close to whatever the actual appreciation rate of the property is. I believe that they should approach each other. Um, that I'm digging way far back in my brain, looking at limits in calculus. I think that that's kind of what that starts to look like. But I haven't done that stuff in forever, so let's just stop talking about the nerdy stuff. So yeah, getting the appreciation, or getting that sort of levered appreciation, even though we don't have leverage. And then the same thing happens on cash flow, right? Like when I'm doing this calculation, I'm doing only 3%, but 3% of the 50, which ends up making sort of a bigger, well, so let's get rid of this again here because it makes it more clear, right? But so, okay, it makes it 4.5%. It's affecting our IRR more, because it is, again, it's based on, when I'm calculating our return, I'm calculating it using the 30, but when I'm doing 3% of cash flow, cash on cash, I'm doing that with the 50. Um, I guess the same thing, you could say the same thing when you buy properties in real life at a big discount. The big difference is you're just not able to do it in the same way that you can on properties on this platform. I mean, we're very routinely you could today do no work whatsoever, or do very little work, get on this platform and find five properties today where you're getting maybe not one that would sell for 50 that you're buying for 30, but definitely one that would sell for 45 that you can buy for 30. That there's a real spread that you can find. Um, and so, getting used to what that math looks like is, and this is why, like, I'm really excited about this opportunity, right? Like, if we can actually make a sale happen within a year of the purchase, I mean, a 50% return for something where your downside is very limited because we've got this real world asset, is amazing. I mean, I think in most scenarios, the downside case is we get stuck holding this for a long time because a lot of the co-owners just think real estate is a long-term asset and don't do the math on, what that looks like for their returns. And so anybody who's got this at a discount, is feeling this in a strong way. One of the things that I think is kind of weird to think about is there's a lot of people that bought this at 50, right? And so okay, the amount that they lose per year goes down the longer they hold it. Um, is that really true? I mean, I guess it is because, well, wait a minute, what's happening here? Oh, because they're annualizing their loss, right? Like, so yeah, I mean, see, you get that same effect, but I mean, it's, you're losing the same amount, and whether you lose it all right now or not, I mean, I think it's just sort of, uh, obviously if they're getting a little bit of cash flow, it helps. But like if you take the small loss now, well, and this is annualized, right? So this is each year, and so then when you multiply this over every year, you're actually losing more by doing the longer holding period. That's right. Okay. I was thrown off for a second. I hadn't done that math ahead of time, and I wasn't prepared for what it was going to look like. But even when you do that, what's happening? You're spreading your loss out. You still have that loss, um, that it's just taking you longer, and you have the opportunity cost of what you could do with that money if you're reinvested. So okay, you sell it today, you take a 10% loss, you put it into the next one of these properties, where you have the opportunity to make a 50% return if you then get the next group of owners on board with selling that next one. Um, and like I'm really even hesitant to show this because, 50% IRR is just ridiculous. I mean, you don't get returns like that in real life very often. I mean, I've been investing in real estate for 20 years, and except for, deals where I'm putting close to nothing down, like you just don't see that type of return. Just because it's very short term. Um, and because, I think it's just an inefficient market right now, right? Where we're just seeing these incredible deals. Um, so, even if you end up, even if it ends up being something lower than that, right? Like, let's say our value is only really 40, right? And then, okay, we have a 20% IRR. This spread exists too on the platform. And to be perfectly honest, I'm not really being too um, picky in between, all of these deals. Like if I get, if I, this spread is smaller than any of them that I'm looking at, but really if I get like a $15 spread, right? So oops, back out of that. So like if I really think it's going to sell for 40, I'm probably buying those tokens at 25. All of these end up just with really nice returns, if you can get a sale early on. And if you're stuck holding it for, 2 years, 3 years, and you're not getting any cash flow, which is the case with a bunch of them, then they just become kind of like ho hum returns, And I mean, like, a lot of people, if depending on what your context is, you might still think, oh, 7%, 9%, I'm okay with that. And I guess, it's not horrible, but if you compare it to what's available and what's possible with real estate investing in general, um, it just doesn't make a ton of sense to stick around there because this is internal rate of return, right? This isn't cash on cash return. This is like actually, total profit when you sell. And so, I mean, there's deals on Mogul where I'm getting, a cash on cash return higher than these two numbers right now. I don't know if any of them are quite passing up this, but then once you add in your appreciation and your equity pay down in those deals, and again, that's a site where I'm relatively new to and could, there's a lot of platform risk as far as I'm just not, they're new and lots of things could go wrong. Um, which is one of the reasons why I'm more excited about these deals. Like if you start to look at the the margin of safety that we have, right? Like what's the downside if my average basis on this is 31 bucks and okay, it doesn't really sell for $40 a token. It sells for, I don't net $40 a token. I net 30, 35, right? I mean, it has to get pretty low to get to 31. And then even then, okay, what if it does? I mean, there's still, then I'm losing a small, I could certainly lose dollars per token, but I've only got 275, right? And so, um, I think it would be absurd to think that this sells at a price that gets you, I mean, when I was looking at all the different scenarios, um, nothing really made me think we'd get less than 37, 38 net, and I really think it's closer to 40 plus. All right, I think I've rambled long enough. Sorry about all of that. Really just wanted to hone in. I was really just doing the math and figured I'd jump on here and talk a little bit about this. And that's what I'm just trying to do is share. And anytime I've got a little bit of a thought on this that might be useful to somebody or that, that I think a lot of people are missing on the platform, I'm just trying to get on here and share it. Um, obviously, uh, at some point, I think I'm going to share my whole model, but I think it's going to take like way too long of a video because you just have so much built into it, which is why I keep giving you like these little snippets of calculations. Let me know what you think, though. If that's something that enough people are interested in, I might take the time, bring my whole model out and go through it. I just don't want to stick it up there on the screen and then not take the time to really explain everything. Um, because I just hate that. I just like to know what every little thing that goes into somebody's calculations are when they're sharing them with me. And so, but I mean, maybe some other people are not as picky about that as me. Anyway, until next time, I'm going to keep making mistakes so that